Welcome to Edison's new series, Real Assets in an Uncertain World. Now, we live in an era of increasing geopolitical instability, higher inflation, and tightening monetary policy. So can investing in real assets provide sustainable, less correlated returns? Industry leaders from sectors such as renewables, infrastructure, media and technology are joining us to reveal their views and deliver actionable insights for a global audience. In this session, we're looking at BBGI, an investment company dedicated to infrastructure. With me, not one, but two co-CEOs, Duncan and Frank Schramm. Let's start with you, Duncan. What are the assets that BBGI invests in and why?
Thank you. What are the assets? We invest in important infrastructure assets with a strong social purpose that serve local communities. So these are schools, hospitals, transportation assets, fire stations, modern correctional facilities, affordable housing, and most recently we had our first clean energy investment. They're all availability based, and what I mean by that is as long as they're available, we get paid, so it's not dependent on use. So as an example, we have several roads in our portfolio, but these aren't toll roads subject to paying a toll. As long as the road is available, we get paid irrespective of how many cars drive along the road. So you can imagine during COVID, we were very happy that we didn't have toll roads because they were still available and we were still getting paid. They're all in highly rated countries, so Australia, Canada, the US, UK, Germany, Netherlands, and Norway. We're all paid by creditworthy counterparties, so our cash flows are contractual, and as a result have a high degree of predictability, which gives a very stable and predictable cash flow, which supports our business model. And there's also inflation protection, which Frank will talk about a little later. And we're very excited to say that there's also a high degree of climate resilience within our portfolio, and we've recently studied that. So those are the assets. You're asking why we do that. By pursuing this low risk strategy, we've been able to deliver very stable and predictable returns for our shareholders. So stable long-term dividend growth, attractive returns. We just celebrated our 10-year anniversary, and as part of that, we told shareholders that we've delivered a 10.4% annualized return since going public in 2011. We've grown the NAV per share at 3.4% each year, and we continue to trade an attractive dividend yield of just over 4.3%, and we have a cash covered dividend and, as mentioned, good inflation correlation within the portfolio.
That's really impressive. So how does BBGI select those assets, and what's the investment process, Frank?
Yeah, before we acquire a new social infrastructure asset, we're going through a multi-stage process. At the beginning, we screen potential new investments if it fits our investment policy generally, but even more importantly, if it satisfies our strict investment criteria. And there are several criteria. So the first one is, Duncan mentioned availability based. That is a core DNA of BBGI. So are the cash flows availability based? So you only invest in this asset class and which is not dependent on demand or occupancy. And that focus has served us very well over the last 10 years. The second criteria is the length of the contracts, and that the contracts are with public sector counterparties. The average life of the portfolio is 20 years, and we actively look for investment with a long contract life. And the second point here is, and they need to be the public sector or public sector backed entity. The vast majority of our clients are highly rated. They are AAA, AA rated. It's Norway, it's Netherlands, it's Canadian provinces or Australian provinces, and UK. It's public sector entities for schools and for hospitals. The third screening criteria is if the cash flows are predictable. So the income side is already predictable because we invest in availability-based cash flows. But what about the cost? We actually have got long-term contracts in place, subcontracts in place with facility maintenance providers or operational and maintenance providers for our schools, our hospitals, and our road projects. So, and in terms of financing, the financing typically is also 20 years plus. So there's no refinancing risk because we got long-term loan contracts or bonds in place actually to fix also the financial side of the contracts. So The revenue side is fixed, and the cost side to a very large extent fixed. So that results in a very predictable long-term cash flows. The topical point also, which we have been looking for a long time, but also it comes more into focus now, is inflation correlation. Yeah, and especially in this high inflationary environment currently, which we are. So our portfolio offers an attractive inflation linkage of around 44 basis points. That means in case inflation is 1% higher over the long term, then actually our returns go up by 44 basis points, or for 0.44%. So we are actively looking for investment with an attractive inflation linkage. Other criteria, obviously, is ESG, environmental, social, and governance, and they have to positively, and each investment has to positively contribute to our ESG profile. Once the criteria are all positive actually screening, we do a rigorous actually due diligence exercise. We go through legal due diligence where we hire a lawyer, technical due diligence where we hire actually a technical advisor, and we also do financial model undertakings or reviews, and also balance sheet reviews. To give you an example, we have recently acquired a motorway project, the A7 motorway in Germany, and that's a good showcase actually. And if you go through the criteria, the cash flow of that investment is 100% availability based. The cash flow comes from the German government, which is AAA rated. The contract is long-term and has got a tenor up to 2044. We've got a long-term bond in place here over the full term, and it's also strengthened our continental European exposure and contributes to our global footprint. And there's also an attractive inflation correlation, which is in line with our wider portfolio inflation correlation.
You mentioned ESG there. How does your ESG approach create shareholder value, Duncan?
Thanks. Yeah, I mean, we think you can do well by doing good. So you can deliver attractive value and returns to shareholders while also doing good stuff within the portfolio. And we're very much the view that ESG doesn't necessarily cost money; it can create value. We see ESG as a risk management tool as well as a proxy for good governance. So we integrate and evaluate sustainability risk in our processes, as Frank talked about. We continually improve that process, and we think by reporting all that, it helps us improve our asset performance. Whenever we acquire an asset, we do a detailed proprietary ESG questionnaire as part of the due diligence, so that helps prevent problems, that could result in poor investments. We systematically consider whether there's material ESG risks and whether that'll impact our investment. Recently, we did a comprehensive climate modeling exercise where we looked at 8 different perils across 3 different climate scenarios over multiple time horizons, and this gave us a lot of comfort that our portfolio is very low risk, not only today but as climate scenarios unfold. We're confident that our portfolio will continue to perform well in the future. And then ESG also creates an opportunity. So we see a lot of opportunities for change orders coming from our government clients as they work hard to meet their decarbonization targets. We also do a lot of ESG within our portfolio that's self-initiated that results in as an example would be we did an LED light replacement on one of our roadways. So it reduces energy costs, improves safety because it's brighter, it reduces energy consumption, it reduces relamping costs. So it has a lot of positive impacts for society in that it's respectful of the environment and makes the road safer, but at the same time it improves our IRR on that investment. And we've gone back and comprehensively looked at our initiatives over the last 10 years, and active management has delivered about 29% of the NAV growth. So it's not just us saying that ESG and active management contributes value. We've got the proofs in the pudding, and we can show that it has had a meaningful contribution to the value we've created for shareholders.
Frank, what's the benefit of being internally managed?
Yeah, we are the only UK listed infrastructure company with in-house management teams here, and we believe there are a number of benefits here. I mean, first of all, what is that? there's no external manager. The whole team, Duncan, myself, and the whole team employed by the company. So there's an external manager. What does it mean? There are no net asset value-based management fees, as there's no external manager. There are no acquisition fees. We have got the lowest ongoing charge within our peer group. Our costs, our staff, administrative costs, audit, or other advisory costs. And if you grow further, the ongoing charge will come down further, as most of our costs are fixed. And the key one for us is the interests are fully aligned with the interests of the shareholders. The management has incentives which are the same incentives which probably you are interested in as a shareholder. It's net asset value growth and also total share return. So we're not incentivized to grow for the sake of growth. And that has resulted in a strict pricing discipline and also no style drift into higher risk asset classes. And our mantra is shareholder value first and portfolio growth second.
And finally, what's the outlook for returns given the place we are at the moment, a very inflationary environment with a lot of geopolitical uncertainty? And perhaps you can take that, Duncan.
So let's break that into two parts, the uncertainty and the inflation. So in an uncertain environment, we take great comfort in our low risk investment model. So we're paid contracted cash flows by very stable creditworthy counterparties. It's not linked to the general economy or the business cycle. We saw this during COVID when our cash flows weren't impacted any material way. We were continued to be paid by the governments that we have these contracts in place with. In an inflationary environment, we're also very comfortable because we are paid inflation protection through the contracts by governments. We pass that on to our suppliers, our FM contractors and our O&M contractors. They have long-term contracts with us where we pay them an inflation piece as well. So we're not worried about increasing costs, diminishing our returns. And we have long-term financing in place, so we're not subject to having to go back and arrange debt in what could be a rising interest rate market. So we're comfortable with the inflation bit. We have a strong correlation to inflation of 44 basis points. So what that means is if returns were to go, or inflation was to go up 100 basis points more than our expectation, we would see 44 basis of pickup through that. So it's not one for one, but it's still very good. So, in an environment that's uncertain with inflationary pressures, we're very confident in our business model, and the underinvestment in public infrastructure, I think, means that there's going to continue to be a reason to do this business for quite some time into the future.
So interesting. Thank you so much, Duncan Ball and Frank Schramm from BBGI.